So financial sector comprises of banks and other institutions along with foreign exchange market. So more precisely, financial sector consists of commercial banks, investment bank, stock exchange operations, that is stock exchange market, and foreign exchange market. So financial sector includes financial institution like banks, investment bank, foreign exchange market, etc. Now, the financial sector in India is controlled by RBI, that is Reserve Bank of India. Now, every bank in India apart from financial bank is controlled by RBI, that is every kind of bank, let it be commercial bank, investment bank, etc. it is controlled by RBI. So RBI decide the amount that every bank needs to keep with themselves. RBI fixes the interest rate and RBI decides what will be the rate of lending, what will be the rate of deposit, what will be the nature of deposit, etc. So RBI decides the amount of money that bank can keep with themselves. Now this is something we call as CRR. Now what is CRR? CRR is nothing but, let's suppose the commercial bank is receiving rupees 100 as a deposit. Now we all know that the basic function of commercial bank is to accept the deposit and use it for lending loan or use it for giving loan. Now if the deposit is rupees 100, RBI requires CRR to be 20%, for example. That is, from the deposit received rupees 100, only 18 rupees can be given as a loan. And now this CRR changes according to inflation and deflation. Hence, like CRR, government decides SLR rate, open market rate, repo rate, reverse repo rate, etc. So RBI decides the amount of money which commercial bank will be keeping it themselves. RBI fixes the interest rate and RBI decides the nature of lending of various financial sectors. Now, one of the major aim of financial sector reform is to reduce the role of RBI from regulator to facilitator of financial sectors. Now, RBI was regulator. Earlier, RBI was regulator means RBI was like a monitor of each and every financial bank. Now, the aim of this reform was to change the role of regulator to facilitator, that is an helper. So now the commercial banks were given more freedom than earlier and it was RBI who would help them with anything they need. This means that financial sectors may be allowed to take decision on many matters without consulting RBI. So earlier, when RBI was regulator, commercial banks or any kind of bank would need to take prior permission on any decision. But now they are given freedom to take decisions without consulting RBI, wherein RBI changed its role from regulator to a helper, which is called as facilitator.